and support. Now, today we're going to talk about Japanese candlestick because Japanese candlestick is another integral part of you becoming a successful trader. And it's easier to get into forex trading in terms of making your trades if you have a deep understanding of what you're looking for in terms of your candlestick patterns. So let's get right into it. So, what exactly are Japanese candlesticks? There is a Japanese saying, consult the market about the market. Now, that means that when observing the market, we should pay close attention to the market movement itself rather than observing the international affairs and economic policies that may or may not affect the market. More than 200 years ago, the Japanese were using a unique style of technical analysis in the rice market that evolved into the candlestick technique that we use currently today. The candlestick chart basically is a recording of market price movement in picture format. Now, this is the basics of candlestick charting technique. The chart's value is not in predicting exact tops or bottoms, but in instantly assisting to confirm current market tops or bottoms when they are formed and providing insight into market psychology. Candlestick charts are used as a standalone tool, but they can also be merged with other tools and indicators or techniques to create a powerful technical analysis system. Certain candlestick combination may imply a period of consolidation. Others hint a more forceful price movement. Overall, they provide deep insight into the market as we see it. So, one of the reasons that candlestick charting technique has become so popular among traders is that it accurately reflects short-term outlook. So, unlike your MACD or your other lagging indicators, the candlestick chart itself tells us what's going on currently. It tells us who is in charge of the market. And this also ties in again with looking at your larger time frame. Because if we're on a 1 minute time frame or a 5 minute time frame, that time period is not really giving us much information. But if we're on a hourly time frame or higher, then we're getting more accurate reading as to what's going on around the world currently. Investors find candlestick charts easily read or easy to understand and interpret, with even rookies or new traders taking advantage of these charts also. So once you're exposed to the patterns of candlesticks, you're able to quickly interpret what's going on in the market. And remember, in previous sessions, I did mention that the market gives us clues. Now, these clues are seen through your candlesticks. Candlesticks are also known to help investors take advantage of human emotion. They can also be used to get rid of emotionally based weakness in their own portfolios. So it's important to digest the information that you're about to receive. And at the same time, once you've digested that information, go out, practice, look for these patterns, look for these candlestick patterns on your charts on your own, and be able to identify them at a glance. So let's get right into it. Now, before I move further, your candlestick patterns or your candlesticks, as I mentioned earlier, are these lines going up here. So this candle represents a bullish market, which means bulls have pushed price upwards. So therefore, price actually opened here and closed here. Price opened here and closed here. Now we are on a 1 hour time frame, so that literally means the open and close of a candle lasts for 1 exact hour. If we move over to a daily chart, every single candlestick that we see here represents one entire day of information. And we use with our MT4 platform, we use GMT time. So we're not using Eastern Standard Time or Pacific, we're using a GMT time. So, the time you'll have to get used to, or you'll have to get adjusted in using the GMT time when it comes to Forex trading. All right, so candlestick charting allows a quick read on changes in supply and demand or basically when price hits a level of resistance and support. Now, there are four basic parts of your candlestick. We have the open, we have the close, we have the high, and we have the low. This basically represents, guess what? It represents bearish, a downtrend, because the market opened here and closed here, which means price went downwards. Now, on the other candle here, price opened here and closed here. So this is a bullish candle. Now, these upper shadows represents the area in which price had traded for that time period. So this means if we're looking at this candle and this is a 1 hour candle, it means that within this 1 hour period, price rallied into this level, got rejected, and then came all the way down to here, created a low, and then closed here. So what this actually tells us or represents is the entire trading range for that entire hour. And again, if we look on our charts, let me actually go down to a smaller time frame. Actually, let me use another chart here and magnify. So if we're looking at, let's say, this candle here, this candle is on a 1 hour, this is a 1 hour chart. So what happened is that the market opened here, it rallied as high as here, came down to this low, and then price pushed all the way back up and closing almost at the same price as it opened. So these little shadows here are what we call wicks, or they can also be called shadows depending on how you want to term it. So these always and also will give us information as to what's going on in the market. Now let's get back to it. Now the body of the candlestick chart is known as the real body and represents the range between the open and the closing price. So the range between the open and the closing price, that is considered the body of the candle. The black or filled in body highlights that the close during that time period was lower than the open, usually considered to be bearish market or seller's market. When the body is open or white, it shows the close was higher than the opening. So in the white candle here, we have the open and price rallied upwards. So bulls pushed price upwards and closed here. The slim straight line above and below the real body is known as the upper or lower shadows or wicks, which represents the high and low price limit for that time period. Now we have two types of candlesticks that we look at. We have the long bodies, which indicates strong buying or selling pressure. The longer the body is, the more intense the buying or selling pressure is. This means either the buyers or sellers were stronger and took control of the market. So when we're looking at a chart, let's look back at this chart here. We can basically look to see with this candlestick here, we had strong selling pressure, right? But when it came to this candle, basically the selling pressure was not that great. And when we moved over to here, the selling pressure was all, the buying pressure and selling pressure was not that great either. So we look at these candles in terms of the length to determine the pressure in the market at a certain time. The short bodies imply very little selling or buying activity going on in the market. All right, so we have the long body, long shadows, which we just discussed earlier. So the long shadows basically tells us a story. And what story this is actually telling us is that while price was going higher and price hit a level of resistance or ceiling, sellers push price downwards within that same trading period. So within that same 1 hour period, the market rallied upwards, but sellers took charge of the market and pushed price downwards, leaving this wick behind and a small body. On the bullish candle, price came down, and as price hits a flooring or a support area, then bulls push price all the way back upwards, closing above with a small body and a long wick left behind. Now, these candlesticks are usually seen, and they're actually very valid, especially if seen at the bottom of a trend or at the top of a trend. And we will discuss this in more details in the next few slides. Now we have candlesticks that are considered to be indecision candles. Now, candlesticks with a long upper shadow and a long lower shadow and a small body in the middle is considered spinning tops. These are called spinning tops. The color of the candles are not important. What's important is the characteristic of the candlestick itself. Now, this candlestick, as I mentioned, just indicates indecision. Why? Simply because price opened here, price rallied upwards, price rallied downwards, then price closed here. So we had an indecision in the market. We had a fight between sellers and buyers, and no one basically won the fight within this time period. Same for our bearish spinning top. Sellers push price downwards, buyers push price up, but then price actually closed in the center with a small body, and then we have two wicks on either side of that body. So this represents indecision in the market. So where would you actually see an indecision candle on this chart? Okay, we're seeing an indecision candle here. We're seeing an indecision candle here. And we're seeing an indecision candle here. So once we see these candles, basically we're saying, okay, neither the bears nor the bulls have taken control of the market, so I'm standing aside. Now we have what is called Doji candlesticks. Now these have the same open and close price, or at least their bodies are extremely short, almost invisible. A doji should have a very small body that appears as a thin line. Again, these dojis are considered to be indecision candles. So the name of the candles or the name of the dojis aren't really that significant. What is significant is the characteristic of the pattern itself, or of the candlestick itself. So when we're seeing a candlestick pattern such as this, it's an indecision. Indecision, indecision, indecision. And on this diagram, we can see a few indecision candles also. Go into our live chart. Again, see if you can actually identify a few dojis. Okay, right. We have a doji right here. We have a doji here. We have doji. We have doji. And this could actually be considered a doji also. We also have a doji here. So these dojis again represents indecision in the market. All right, so back to what we consider to be our pin bar. Now, pin bar, based on who you'll hear it from, they can be called pin bars, they can be called kangaroo tails, they can be called hammer, but again, it all represents and signifies the same thing, reversal. So your pin bar as a standalone indicator is a very strong and valid indicator that suggests reversal. So as the market rallies, so the market's trending upwards and hits a level of resistance here, we see a price rejection on this candle. So this price rejection basically is saying sellers are now taking charge of the market. That's why we got this rejection in price right here. Therefore, it's leaving a long wick behind and a short body. So when we're looking at a pin bar, basically we want to see the wick at least 2 to 3 times, at least 3 times the length of the body of the candle itself. And the longer the wick, the more significant that signal becomes. And this also, as I said before, it represents a turning point in the market or a stall in price, at least temporarily. So once we see this, then we have an idea as what is going to happen next. In a downtrend, same thing happening. Price comes down, hits a support area, and boom, bulls push price all the way back up, leaving a wick at least 3 times the length of the body of the candle itself. Therefore, this again signifies a reversal back to the upside. And I will actually show you guys how you would actually trade this in the next few slides. Next up, we have combo candlesticks. So what we're looking at now is a bearish engulfing candle and a bullish engulfing candle. Now the bullish engulfing candle is a 2 candlestick pattern that signals a strong up move may be coming shortly. It happens when a bearish candle is immediately followed by a larger candle to the upside. So as price begins to fall or price continues to fall, it hits a support level. Then it leaves this bearish candle behind. And then we have a bullish candle that follows suit. So hence the word engulfing, because we want to see the bullish candle actually engulfs the previous candle, which is your black candle here. Now the color of the candle is actually significant at this point, because we want to ensure that we have a bearish candle and then we have a bullish candle that engulfs the previous candle. Now, our bearish candlestick pattern, again, is a 2 candlestick pattern that signals a strong down move may be coming shortly. It happens when a bullish candle is immediately followed by a bearish candle. So just like we just indicated on the here with our bullish candle, on our bearish candle, we have the market rallying upwards, creates this level, this bullish candle here at a resistance level. And then boom, we have this bearish candle that engulfs the previous candle. So this signifies a bearish engulfing. And again, this also signifies a reversal in the market, because what happened is that we have sellers taking chart of the market, breaking this previous trading session low point. So once that happens, it's basically a heads up to say, okay, you know what? Price could be reversing again. We are at a resistance level, so I am going to now look for reasons to go short. So these are all clues that we're seeing every single time on any single time frame. And one thing to keep in mind, guys, is that the higher the time frame, the more significant these candlestick patterns actually are. Another set of candlestick patterns that are not all that great, not all that significant, but they can be a good signal, are your tweezer tops and tweezer bottoms. Now, the tweezers are dual candlestick reversal patterns. This type of candlestick pattern are usually spotted after an extended uptrend or downtrend, indicating a reversal will soon occur. Now, notice how the candlestick formation looks just like a pair of tweezers. So one thing to keep in mind is that the depth of the shadow itself should be of equal length, and the height of the wick should be of equal length to your previous candle. Also, the colors of the candle is also significant. So in a downtrend, we want to ensure that this candle is bearish and the candle that follows is bullish. In an uptrend, reversal to the downside, we want to ensure that this candle here is bullish and the candle that follows is bearish. So that actually tells us we're going to have a potential reversal in the market. Now, another favorite pattern of mine are the morning star and evening star pattern, and they're quite easy to recognize, because what we're seeing is an actual turning point in the market here with these 3 candlesticks. So the morning star and evening star patterns are triple candlestick patterns that you can easily find at the end of a trend, whether it's an uptrend, or a downtrend. There are reversal patterns that can be recognized through three characteristics. First characteristic is that we have a bullish candle, which is a part of a recent uptrend. The second candle has a small body indicating that there could be some indecision in the market. This candle can be either bullish or bearish. So when we spoke about those indecision candles like the spinning tops, spinning bottoms, or the dojis, those are the candlesticks that we're looking for. The third candlestick acts as a confirmation that a reversal is in place as the candle closes above the midpoint of the first candle. So let's get back to this. So when we're looking for a morning star pattern or an evening star pattern, this is basically what we're looking for. A bearish candle, an indecision, and then we have a bullish candle right here. And we want to ensure that these candles are also long in terms of length, because again, that signifies pressure. Exactly. So we have bearish, indecision, decision, bullish. And I'll actually show you guys how we actually trade this on a day-by-day basis. In an evening star pattern, price is going up, hits a level of resistance. We have a bullish, we have an indecision, and then we have a decision to go short. So this is actually giving us some clues that price is actually going to reverse. And it's all about following the market and being confident and believe in what you're seeing. That's all it's about, guys. Believing in what you're actually seeing, not what you feel, but what you see. All right, detecting the right candlestick. Now, as you practice and you will learn, you'll understand that size does matter when it comes to Forex. And what we want to do is we want to be able to detect these patterns and determine possible actions before taking it. Now, there are three simple rules to interpreting candlestick patterns. One, as we just mentioned, is the size of the candles. Second, the shape of the candlestick or pattern determines the type of pattern generated, the possible trading signal, and the potential direction of the trend. Shape and size work hand in hand. A very small bullish candlestick pattern would indicate the potential of a market rally. Yet, the small size indicates that the trend has not yet begun to accelerate. So, again, we want to keep the shape and the size tied together. Most importantly, we want to ensure the location of the candlestick. The location of the candlestick pattern will assist in determining the possible trend direction or trend trading signal. So, when we're looking at a candlestick pattern, one thing we want to see is that first, we want to look at a larger time frame as to what's going on. Then we want to identify that resistance level. So let's take a look at here. And let's say this is our resistance level right here. Okay, and let me get this here. All right, so we want to look at what went on smaller time frames with this candle. As a matter of fact, let's use this candle here. Let's use this candle. So we want to see what happened on smaller time frame when price got into this level of resistance. So we've already identified that price came into this location, into this area, or into this price point and got rejected. Price came down, rallied back upwards. So we want to see what was happening on smaller time frames at that point. So let's actually move down to the smaller time frame. As a matter of fact, let me actually open another US chart. So what I'm going to do is I'm going to delete this chart and I'm going to delete this chart temporarily. And then I'm going to put both charts side by side. So we have 1701.03, 0 hours. So let's look for that over here. 1701 Okay, let me get rid of this for now. So we're going down to January 3rd. So we want to find 0 hours. There we are. All right, so we're at 2017 0103 0 hours, 2701 03 0 hours. So this is what happened. So as we've identified this area as resistance, and let's use 118.46. 118.46. Okay, so there we are. All right, so as price rallied up, because notice we had this move to the downside. Let me get my drawing tool here. So we had this move to the downside, and then we had a pullback, right? So this move to the downside basically is probably this move here. No, sorry. What am I actually doing here? Okay, so everything that we're looking at is on the other side of this line here. So as price got into this level of resistance here on your larger time frame, look what happened. Price spiked upwards, so we're in an uptrend. Price made one final attempt to the upside there, stalled for a minute, and boom, we had another spike upwards, and then price fell. So what we're seeing here is a rejection with this candlestick right here. So this is not your typical pin bar pattern or pin bar, because even though this is around 2 to 3 times the length of the body, I would still not consider this to be a valid pin bar, but it is actually an indication that price got rejected at this level. So this is exactly what we're looking for. We're looking for price rejection at 118.46. We're looking for price rejection at 118.46 there, and this is what happened. So as price gets into this level of resistance, this is where your trading opportunity lies. So once price does this and gets up into here, because this is what we could actually have done. We could have simply, when we're looking at the market, pulling back into here and pulling back upwards. We're expecting that, okay, the market rallied up, market came back down, and then the market's probably going to rally again once more. So when price gets into this level here, you could have actually set a sell pending order right here, somewhere off this area, this resistance zone area, to go short. So as price gets into that level, and notice what happened. Price spiked upwards, didn't hit the resistance level just yet. And then we had one final attempt, one final burst upwards, which pushed price up, and then price got rejected. So let's say you want to be a little more conservative, and we see this happening on our chart. So we're waiting for some price reaction here. Now there are multiple ways in actually going into this trade, and I'm going to show you all these ways. For one, the first thing we want to do is, as I said before, we want to identify areas of support and resistance. So on this chart here, before price got into this level, we have already identified this area as resistance, 118.46. So what we're actually doing is waiting for price to get back into 118.46 support resistance zone, where we're going to be looking for trading opportunities. So as the market rallies upwards, and pulls back, makes one final attempt upwards, and we see this candlestick here, this is your reason to go short. So with this break of that support there, this area of consolidation here, then you could have actually gone short here. So that's one way of going into the market, with your stop loss obviously above the high there, and your take profit would be all the way down here at your next level of support. So that is one scenario in getting into your trade. The next scenario is this. Again, everything ties around this area. So basically what we're saying, okay, is if this is our swing point, boom, boom. So we're saying now if price pulls down back into this level of support, hits that support level right there, what are we expecting? We're expecting a pullback to the left side of this shoulder. However, we did get a small pullback, and then price made a small retracement and then made one final attempt upwards. This is why it is important to keep your stop losses outside of these swing zones. So another way of getting into this trade is to say, okay, once price gets into this level of support, so this is number one. This is the first thing you want to see happening. You want to see price getting into support. Next, it's up to you now in deciding where am I going to go short. So you could have easily have set a sell pending order just above here. So once price gets into that level of resistance, boom, your selling order would have been triggered. But you want to ensure that your stop loss is outside of the swing zone, so you'd have kept your stop loss up here or even here. So the worst thing that can happen is that price retests that high and then fall. So again, we want to keep our stop losses outside of the swing zones, okay? All right, so that's one way of getting into your trade right there. Now, another way of getting into your trade, and okay, let me do this one more time. So price rallied upwards. Price got into this level of resistance. We see that price got rejected here with this candle. So now we have no idea what's going to happen here. But this is exactly what we're planning to do. So we are planning our action, and once the market works itself out, then we know exactly how to get into these trades. So what we're looking at to say is, okay, I want to see price get into this level of support. That's the first thing I want to see happen. So once this candle is created, I want to see the market come down to here. Now, once price gets down to here, then I am going to set my stop. I'm going to set a sell pending order here at the left tip of the shoulder. So I'm going to set a sell pending order right here. So when price gets into this level, it will create the right side of the shoulder, and then I'm expecting price to fall. My stop loss is going to be above here. So if for worst case scenario, price retests this high, my trade is still good because my stop loss is all the way up here. So if price creates that double top pattern, then my trade is still active and I'm still expecting the market to fall. So that's scenario number one. Scenario number two is simple. Now, first thing you want to do, you want to identify where your stop loss is going to be, which is going to be above here. The next thing you're going to look at is say, okay, how much am I willing to risk on this trade? Or where am I comfortable in getting into this trade? So we can actually look at this level of support, past support becoming resistance, and basically set a pending order here. So we'll be setting a pending order here to say if price gets into this level of resistance, this is where I am comfortable in getting into that trade with my stop loss here. And once price gets into that level, that's it. The rest is left up to the market. And if it doesn't get into that level, so be it. I'll just move on to the next trade. So what we're doing is that we're looking at different paths in which the market can move. And we are taking action if and only if the market does what we want it to do. So in this scenario, you're waiting for price to come to you. In both scenarios, you're actually waiting on price to come to you. It's just where you're comfortable in getting into that trade. And then look what happened. Price sold off. Now, third scenario is this, and this is a little bit more on the conservative side. So price rallied up, and let me change the color of my shtick. So price rallied up, boom, came back down, hit support. What's that telling you? it's actually telling you that bears are now in charge of the market. So what we're actually looking to do is to sell, because for one, we have hit a level of resistance on our larger time frame, so we want to follow the direction of the market. So once price hits that level of resistance, we're expecting the market to retrace or to pull back or get rejected at this level. So on your smaller time frame, you're looking for confirmation. So another way to do this is to say, okay, boom, price came down to that level of support. Then I'm expecting a pullback. We don't know where that pullback is going to be, but we're expecting a pullback. But I am only going to take that trade if price breaks this neckline here. So boom, price came down, broke the neckline, pull back into support. Past support right there. The market found resistance, and then sold off. So again, what are we seeing here? We're actually seeing a high, a lower high, lower low, lower high. So now we're in a confirmed downtrend. So we execute our trades right here, or we set a pending order here. So as soon as price breaks with this candle to the downside, that's your trigger to go short, because now the market has broken this level of support. So that's your reason to go short. We need no other information than just to go short. The only thing we want to do is we want to determine at what price am I going to go short at. So am I going to go short on the pullback, past support, becoming resistance? Am I going to go short here? So am I going to set my sell pending order here? Or am I going to look for an area of support, an area of past support, becoming resistance, and that's the area I'm going to set my pending order to go short. So as price comes down and breaks this level of support, then that's when we decide to set our pending order either here, or we can look to set our pending order here. And of course, our stop loss is going to be outside of the swing zone, because this becomes your new swing point. And the market rallied up, past support, becoming resistance, then boom, the market sold off to the downside. Again, if you notice from your daily chart, the market has been giving us clues. Clue number one, we're at a resistance level. Clue number two, price got rejected on your smaller time frame. Clue number three, price came down, hit support. And remember, if the market was actually going to continue going upwards, price will not have come all the way down 100% of this move to the upside. So the fact that price came down and hit support, it means now the odds are in our favor that the trend is actually reversing back to the downside. So those are the clues that we have. Clues number three, we get a pullback, we get a reversal, we get a break of this support level, if you're looking for added confirmation. And then your only question is, at what price am I comfortable in getting into the trade? Am I getting into it here, or am I going to get in at this past support, becoming resistance with my stop loss here? Am I comfortable in taking this amount of risk, or am I comfortable in taking this amount of risk? That's the only question you ask yourself. But at the end of the day, you want to ensure that your stop loss is outside of the swing point, and you're actually going to be in the trade to go lower. Because if you're not in the trade, you're not going to make money. All right, so that takes care of that. So your location is of the most importance when it comes to Forex trading. Location, location, location. That is important. So let's look at another set of examples. All right, so in this scenario, we had price rallying upwards, strong uptrend, price boom, hits that level of resistance. Then price came back down, got rejected, came back down, found support here, and rallied once more, hitting said level of resistance right there. And what happened? It created a bearish engulfing candle. So the fact that it created a bearish engulfing candle, it means that this level is now holding. And what we're looking to do is to get into that trade. Now, there's something I consider, or I call, the 50% rule, or the 50% entry. Now, the 50% entry is getting into your trade on a pullback 50% of this entire pattern. So we can actually eyeball it and say, okay, 50% lies here. So once price gets into this level of resistance, then I'm going to execute my trade to go lower. So what we're actually doing, we can use this as a single time frame strategy, which we can do this on a 1 hour time, on a 1 hour chart, or we can use the strategy that I just showed you by applying multiple time frames to your trades. So in this scenario, what we're actually doing is we're waiting for a pullback, therefore we are getting in at a better price. And what that does is that it minimizes our risk and it maximizes on our profits. So on the 50% pullback, where our pending order would be here, or we're going to sit our computer screen and wait until we get a pullback, it doesn't matter, with our stop loss above those highs. And then boom, we're looking to exit the trade at the next level of support. So we could have easily exited here, but of course price broke through, came down to support, and guess what happened? At the support level, it created a pin bar. Now here's where it gets tricky. Now for most people, when we're looking at pin bars, we're saying, okay, there's a bearish pin, there's a bullish, this is a bullish pin bar, so I'm going to look to buy. No, we do not want to play both sides of the fence, especially as a new trader. We do not want to play both sides of the fence. So if we're bearish, we're only looking for sell signals. We can't look for buy signals in a bearish market, and we can't look for sell signals in a bullish market. So once we understand, or once we know that price is trending downwards or we are bearish, then we're looking for bearish signals. So this is just a reason to get out of your trade had you gotten into the trade here. Not to reverse position, but to get out of the trade and wait for another entry when price pulls back into, you guessed it, another area of support, becoming resistance. So on a pullback, look what happened. It created another pin bar right here. Past support, becoming resistance, you got your pin bar. And then that's your entry to go short. Again, not only did it create a pin bar, it also created an evening star pattern right there. So we can look at this as a pin bar standalone. We can look at this as a pin bar in combination with an evening star pattern, and that's your entry to go lower. Again, for added confirmation, we could have simply drew a trend line. Boom. We draw a trend line, market broke, pull back into that trend line. That's your entry to go short. And option number 3, wait until price breaks this level of support. Boom. That's your entry to go short. But we don't want to give up too much pips when we're trading, right, guys? So again, once we see past support becoming resistance or past resistance becoming support, that is a strong indication for you to now go short in the market. And the next thing you're going to ask yourself is, okay, can I afford to take this trade with a stop loss above here? That's the next thing you want to ask yourself. Again, we could also keep our stop loss here, because this is actually a resistance level. Now, for me, how I would actually personally take this trade is when price does this. So it can rally upwards. This is my confirmation that this level should be holding. Then once I see that sell off, let's say here, pull back, that's my entry to go short. Now I can keep my stop loss above here, because now I'm starting to see the market making lower highs and lower lows again at this point. Because to get into your trade here, the ideal area in placing your stop loss would be all the way up here. We could take a chance and keep our stop loss above these highs, But guess what? We're still within this trend or within this swing point. So we could simply take a chance, keep our stop loss above here, and basically have it in our mind to say, okay, if price actually takes me out here, if I get stopped out here, then I'm willing to get back into the trade when price gets back into another level of resistance. Let's say here. So you already have that mindset that if you get stopped out, you're gonna get back into your trade when price gets into another level of resistance. With now your stop loss outside of the swing zone. All right, next scenario. Here we have a 1 hour time frame. Price created a pin bar, market created a pin bar at a support level. And when we see these pin bars, we do not want to see anything to the left. In an uptrend, we don't want to see anything to the left. So with this pin bar, we did not get a 50% pullback or 50% retracement, but we got another opportunity to get in the trade when price broke this level of resistance here. So we see this pin bar, we start seeing the market rallying, boom, hit that level of resistance. Didn't get a pullback, but price broke out, rallied up, then pull back here, where this is an area in which we could have gone short with our stop loss below here. Because this is a consolidation area. This is a support area that if price actually goes down and takes us out, then we want to be out of that trade. And then once price gets back into here, we could actually look again for other trading opportunities to go long. So here we see the pin bar, price is reacting from the pin bar to the upside, got that pullback past support, becoming resistance right there, and that's your entry to go long. Here we see a nice Morningstar pattern. Price was trending downwards, Morningstar pattern created. Of course, there were no pullbacks. So for me personally, I would have stayed out of this trade, honestly. Because one thing I hate to do is chase after the market. So when price closed there, my stop loss would have probably been a little bit too wide for me to get into a trade like this. And again, even if it isn't, I like seeing those pullbacks. I like seeing those pullbacks before getting into my trades. So that is actually one of my criteria when it comes to entering into my trades. I want to see a pullback. Now, here we see a consolidation area. So here we see the market going sideways. It's not going up, it's not going down, it's just simply going sideways. Now here we see a few failed patterns. We see a failed bullish engulfing. Market rallied up, came back down to support. Over here, we had a failed pin bar, and here we had a failed Morningstar. Why? Because we're in consolidation phase. Price wasn't trending at this point. So none of these patterns are actually valid. Then we finally saw that price rallied out of resistance, and then boom, came back down. Now, I'm going to put you guys to a test right now. And I'm going to ask you, why do you believe that price rallied out, broke out of resistance or broke out of this consolidation area only to sell off right here? So I'm going to give you a second to ponder on that for a while, and I'll give you the answer. All right, enough messing around. All right, so the reason why we had this breakout and then price pull back in is simply because if we're looking at, let's say this is actually a 1 hour time frame. So we're on an hourly chart right here, and this is what we're seeing. So we're not using multiple time frames to get into our trades. And we see price break out of this level of consolidation. Most traders are going to jump on board to go long. But for those traders who were watching the larger time frame, let's say they were watching the daily chart, then they would have seen something like this. So on your daily chart, we saw that price was going downwards. Then price was consolidating, which is this. And then price started trading upwards. So on your larger time frame, you would have already identified an area of past support becoming resistance. Let's do this. So price would have actually, you would have already identified an area of resistance on your chart. So your thought process now is that you're bearish, but you want to go short when price gets into this level of resistance. So as price kept moving sideways, price made one final attempt out of consolidation area, which is this move to the upside, hits that level of resistance on your larger time frame right here, and then sold off. So on your larger time frame, what happened is that price just spiked upwards, hitting that past support, becoming resistant. Then we had a sell-off right there. So that's one of the reasons why we get these false breaks, because we are not paying attention to the larger time frame. And therefore, this is where we get screwed. So it's important to keep abreast of your larger time frame and try to trade in the direction of your larger time frames at all time. All right, so on this slide, we're seeing again a bullish engulfing candle at a support level. So again, we should have already identified an area of support based on our larger time frame, and we'll be looking for trading opportunities at this level. So as the market kept trending downwards, boom, it hits that level of support. It creates that bullish engulfing candle, and then using your 50% rule pullback or your 50% entry, then you would have waited, or you'd have identified your 50% area, have your buy pending order here with your stop loss below here, and then we'll be looking to exit the trade at the next level of resistance, which would be around here. So the market would have come down into that level of support. Notice with our stop loss outside, our trade is still safe because the market actually retested this low barely and then started to rally. So again, we got into the trade here, market rallied upwards. Now, as the market rallies, what we're looking to do is we're looking to buy again on a pullback. So on this entire swing here, identify where you'd have actually placed your buy limit order to get back into the trade. So you have already exited here. You're done. We have no idea what's going to happen over this side. So where would be your reference point in getting back into your trade if you're looking to go long once more or looking to buy once more? Exactly. We'll be looking at past levels of support or past level of resistance becoming support. So here, anywhere along here, would have been your zone area to get back into your trade with your stop loss below here. So now we're actually seeing an uptrend developing, because what happened is that at this point, price hit that support level, rallied. So we had boom, price came down, rallied up with this strong candle, pull back. So this is your new low, or your low, your higher low. Then price broke out of that level of resistance right there. Boom, price came back down. So now we have a series of low, higher low, higher high, higher high, and higher low. Then here, market rallied, spiked a bit. Guess what? It got rejected right here. Past level of support becoming resistance. Market pulled back a tad bit and then boom, took off. So here is where multiple traders or other traders are actually seeing a trend being developed and jumped on board the train to push price higher, pushing price outside of this range. And boom, price pulled back in, past support, past resistance, becoming support right here. Then market just basically started going sideways at that point. So it's easy to actually follow the market if you know exactly what you're looking for. So I'm urging you guys to, practice as best as possible, because these trades, these charts, they're always giving us clues as to what's going to happen next. And not to say every single time we're going to be correct. We're not going to be correct every single time, but what we need to develop is a sense of consistency when executing our trades. We know exactly what patterns we're looking for. We know exactly how we're going to get into these trades, and therefore we have an idea of the outcome. And it's not on a trade by trade basis, as I mentioned in previous slides or in previous lessons. What we're looking for is consistency, trading the same thing over and over and over again. And with good risk to reward money management, we are going to make money. So on this trade, on this slide, we see price rallying upwards, again, hitting that level of resistance right here, and got rejected. So here we see another attempt to go higher. Price failed. Now with this move to the downside, price did not break this low. So for me, I would be a little bit weary as to getting into a trade at this point. So what I would actually would have done here is to say, okay, I'm going to use this level as my breaking point. If price breaks below this level of support, then this is my entry to go short, because what I'm going to see is another rejection here and a break of a support level. So that's two things that we're seeing right now. We're seeing a rejection at this resistance level, and we're seeing a break off a support level. So on a pullback, that's now your entry to go short with your stop loss above there. And if you pay close attention to the trade here, we'll see that the market has been going down, pullback, past support, becoming resistance. Market fell, past support, becoming resistance. Market fell, past support, becoming resistance right there. So on this one trend alone, we could have gone into that. We could have opened multiple positions at this point. So we could have opened a position here. So this would be position number one. Then this could be position number two. This could be position number three. And here we could look at position number four. So would have been in we'd have had 4 open positions on this one trend. So one thing you need to remember, the trend is your friend until it bends. And how the trend would bend and how would we actually determine that the trend is bending is trend line. We draw that trend line. Now the fact that if price rallies up into that level of resistance, what's now going to happen? Our bias should now be changing to the upside, because price has now hit a level of resistance. So the pattern, which was once in a downwards movement, is now shifting to the upside. So once price gets back into that level of resistance here, guess what? We're expecting a pullback. Then this would be our entry, stop loss below here. Then we start taking the trade going higher. So here we would see an inverse head and shoulder pattern. Left tip, head, right tip, market rallies. All right. Now here, blank chart, and what I want you guys to do is just simply take a moment and identify the name of the patterns that we're now seeing here. So I'll give you a second or two. Okay, all right, so number one, we have the market rallying up, hitting a level of resistance. So this is a bearish engulfing candle. Market came down, hit a level of support, turned. This is a bullish, so BL, engulfing candle. Then market rallied up, pulled back into a support level there, and created another bullish engulfing candle. Market rallied up to resistance and created a turn. So here we have an evening star pattern. Market came back down, rallied up again, and turned, creating another evening star pattern. Then the market fell off back to support levels and created a morning star pattern. So on this chart alone, there were multiple opportunities in getting into a trade. Now, this is more for the advanced traders who are more active in the market, who has the time to identify these patterns and trade them. Because again, it's all about trading what you're seeing, not what you're feeling.